Hi. Today we're going to start chapter 4, so we're back into our original textbook. I think the last couple days that we've gone back and reviewed basic transactions, normal balances, and then we did some financial statement work. I think that's going to really help you with this chapter, and some of this chapter is going to be a review because of what we just did. Okay, so in chapter 4, we're working through completing the accounting cycle. All right, so we got a wide variety of things that you're going to be working on throughout this chapter. We're just going to cover the first couple learning objectives in this lesson. So one thing we're going to cover is preparing financial statements. And we did do that in our review that we did the last couple of class periods. We did the income statement and the balance sheet. We're going to go into a little more detailed balance sheet in this chapter, but it's still the same premise as it was for what we did the last couple of days. Okay, so the financial statements that we're going to look at are the income statement. We know because we did it. We've done income statements before. That reports the revenue and expenses and determines and shows that the business either had a net income or a net loss for that period. Okay? Remember, it's revenue minus expenses. If the revenue are greater than expenses, you have a net income. If expenses are greater than revenue, then you have a net loss. We're also going to do a statement of owner's equity. Now, we did not do one of those in this last review, but we did do the work that you are putting into the statement of owner's equity. And I'll explain that when we get to that statement. But the statement of owner's equity shows how capital is changed during the period due to either the net income or a net loss and owner withdrawals. Okay. In the review we did the last couple of days, if you remember when we did the balance sheet, we had to compute a new balance for capital. Well, that's what you're going to be doing on the statement of owner's equity. You're just going to be showing that work. Okay? And then we got the balance sheet. You did that the last couple of days. Remember, balance sheets just show the assets, liability, and owner's equity as of that last day of the period. And it shows that our accounting equation is good. In other words, assets equal the total of liabilities plus owner's equity. Okay, so you did that in the last couple of reviews. This one's going to be a little more detailed. So all of these financial statements, you get those numbers from the adjusted trial balance. So after adjusting entries have been made, we did that last chapter. We did that adjusted trial balance. All of the numbers that you get from that or to do these statements are coming off that adjusted trial balance. So, what is the relationship between these three financial statements? Well, they all relate to each other. The net income or net loss from the income statement will flow into the statement of owner's equity. Your ending owner capital from the statement of owner's equity, that's going to flow into the balance sheet. So therefore, you have to do it in that order. You have to do the income statement first, then you have to do the statement of owner's equity, then you can do the balance sheet. You cannot do those out of order because you'll need some of that information from the previous statements. So I've put these exhibits on your notes just to allow you to kind of see how that all flows. So this is an example of an income statement. We have the net income that we computed here. That dollar amount is going to flow over to the statement of owner's equity, and it's going to go right on the net income for the 2 months. In this case, it was a 2-month period. Okay. Then this is an example of a statement of owner's equity. Your ending thing that you're computing on the statement of owner's equity is the new capital balance. You're then going to take that new capital balance and that's going to flow to your balance sheet. Okay, so that flows right there. Like I said, in the last couple of days review, you did all of that. You computed that new capital. You just kind of did it off on the side. In this case, you're doing it on your statement of owner's equity. Okay, you can see it's the capital balance plus net income minus withdrawals. You've already done that work. Okay, and then the balance sheet shows that our total assets equal our total liabilities and owner's equity. Okay. What you're going to be doing is you're going to be doing what's called a classified balance sheet. Okay. And all that is a classified balance sheet places each asset and each liability into a specific category. Okay. Assets are shown in order of liquidity. Okay. And liabilities are classified as current. That means they're due within 1 year, or long term, which means they are due after 1 year. Okay, so the current cut line is 1 year. All right. Liquidity, what that means when I say assets are shown in order of liquidity, liquidity measures how quickly and easily an account can be converted to cash. All right. So, for example, your cash account, you can easily withdraw cash out of the bank. That is very liquid, okay, or highly liquid. Where other things like a building, for example, a building would not be considered very liquid. You can convert a building into cash, but you have to go through the process of selling it. That can take time, so that would not be considered very liquid. Okay, so assets are always shown in order of liquidity. So your most liquid assets usually are first down to your not so liquid assets. So as we said, current assets can be converted to cash, sold, or used up during the next 12 months. Okay, or within the business's operating cycle, if that happens to be longer than a year. The operating cycle, that's the time span when cash is used to acquire goods and services. These goods and services are sold to customers, or the business collects cash from customers. All right, I could tell you almost all the problems that you ever do. Current is within the next 12 months. All right, so if any asset can be used up within the next 12 months, that makes it current. Okay. Long-term assets are all the assets that will not be converted to cash or used up within a business's operating cycle or 1 year. Okay, whichever is greater. Almost all the problems that cut off will be 1 year. Okay, so an example of a long-term asset would be a building. You're gonna have that building. A business will have that building typically more than 1 year. That makes it long-term. Okay. Accounts receivable, that would not be long-term because you're going to expect payment from your customers within 1 year. Okay, so current is any asset that will be used up or collected within a year. Long-term assets are any asset that will not be used up or not be collected within a year. Okay, so a long-term investment, those would be things like bonds or stocks that they intend to hold for longer than a year. As I said, property. Plant and equipment. Most equipment is used up longer than a year period. That would be considered long-term. There are some intangible assets. Intangible assets are assets that have no physical form, but they're valuable because of special rights carried. So this would be like a patent. Okay, a patent, as most of you probably know, that's something that is protection on an invention that you have. Patents tend to last 20 years. That would be a long-term asset. All right, the liabilities on a classified balance sheet are broken up into current liabilities. Those are debts that we have to pay within a year. Examples of that: accounts payable, salaries payable, and unearned revenue. Okay, most of the people we owe money to are going to expect that payment within a year. Our employees are certainly going to expect to get paid within a year. And any unearned revenue that we've received, they're going to expect us to do that work within a year. So that makes it current. Long-term liabilities are liabilities that do not need to be paid within 1 year or within the operating cycle. So long-term liabilities would be things like a mortgage on a building, okay? Where we go to a bank and get financing, we borrow money so that we can purchase property or land. Most of the time, those mortgages are anywhere from 10, 15 to 30 years, okay? That makes it long-term. We're not going to pay it within a year. The owner's equity section of a classified balance sheet. Owner's equity represents the owner's claims to the assets of the business. So it's asset minus liabilities. That reflects the owner's contributions. So owner putting money in, any net income or net loss, and any withdrawal of equity from the owner. Okay. As I said, it represents the amount of assets left over after the business has paid its liabilities. So this is what a classified balance sheet looks like. So you can see the assets are broken down into current assets and your long term, which is labeled as property, plant, and equipment. Okay. So it's not labeled long term, it's property, plant, and equipment. You could see that accumulated depreciation is factored in. We have done depreciation before. We know that's the decrease in value of an asset. So notice it says like building, our buildings have depreciated 250, so we use less accumulated depreciation. The 250, because we're subtracting, that goes in parentheses, and then the total here. So you can see you got 3 columns. Use this example, okay, this exhibit, use this to help you whenever you have to do a balance sheet. I do not expect you to memorize, this right away. Okay, so use this as an example of, what columns do I have to put it in so that it looks nice and neat. Notice this balance sheet. Some of the balance sheets we did the assets on the left side and liabilities and owner's equity on the right. This is all right down the line, but it's still your total assets have to equal your total liabilities and owner's equity. Okay. Now we did do a little work with worksheets over the last few class periods. So you can use those worksheets to help you prepare these statements. So the first 4 sections of the worksheet, we've done, we used the worksheets last chapter to figure out adjusted trial balances. Now we're going to add a couple columns onto that worksheet. Okay, so your 5th section, a new section that we're going to use, is just an income statement columns. And that is just where you're going to put those dollar amounts for any of our revenue and expense accounts. So anything that goes in on the income statement, that's going to go in that income statement column. And the 6th set of columns, that's our balance sheet. That's every asset, liability, and equity account except for those revenue and expenses. So cutting off after drawing. Okay. And then the 7th section is just determining whether there's a net income or a net loss. And then balancing that amount for the income statement and the balance sheet. Okay. So this is an example of a completed worksheet. We did all of these in the last couple class periods. Okay. We did the unadjusted trial balance. We then did our adjustments. So this has a bunch of adjustments here. And then we did the adjusted trial balance, which is simply the unadjusted trial balance, then factoring in any adjustment. For example, we had accounts receivable, had a debit balance of $1,000. We did an $800 debit adjustment. Debit and debit, that means we add. So it's new balance, or the balance for the adjusted trial balance will be $1,800. Office supplies had a $500 debit balance. We did a $400 credit. Okay, debit and credit, so we know we need to subtract. Its adjusted trial balance is $100 debit balance. So we did all of that last couple class periods. You know how to do that. Now all you're doing is you're taking these numbers from the adjusted trial balance and planning out your financial statements. So the income statement, we know income statements are for revenue and expense accounts. So our first revenue, and our only revenue account, is service revenue. We look at the adjusted trial balance. It has a $17,500 credit balance. We're just sorting that into the income statement column. We're not doing anything to the balances here. So it's a $17,500 credit in the adjusted trial balance. We put it as a credit in the income statement. We're not changing any balances. We are simply sorting all of these accounts out into whether we're going to put them on the income statement or we're going to put them on the balance sheet. So all the rest of them are expense accounts. So those all go in the debit column of the income statement. Everything above our revenue account goes in the balance sheet. Okay? Because remember, balance sheets is for assets, liabilities, owner's equity. Once again, we are not changing any of these balances. We're not doing anything to them except for sorting them into the balance sheet. So then when it comes to doing our financial statements, let's say I have to create my income statement. I just have to look on my worksheet. I find, oh, here, these are all the accounts that go on the income statement. I have on my revenue $17,500. I've got all of my expenses here that total up $8,950. So once you have sorted out all those accounts, look down here. The debit column for income statement totals $8,950. The credit column totals $17,500. So we subtract those and we write the difference under the smaller number. So 17,500 minus 8,950 equals 8,550. Okay? This is our revenue. These are our expenses. We know from our work before, revenue minus expenses equals net income. So this 8,550, that is our net income. So we just write that right there. Okay? If the total of our expenses was greater than our revenue, we'd subtract, the difference would go into the smaller number, it'd be right here, and that would be a net loss. Okay? We then add up our balance sheet columns. In the balance sheet columns, the debits total $119,100. Our total of our credits here total $110,550. We subtract the difference between these two columns. The difference goes underneath the smaller number and it equals 8,550. Look at that. The difference between the two income statement columns is 8,550. The difference between the two balance sheet columns is 8,550. They have to match. If these numbers do not match, you've done something wrong. And you should probably start to make sure first that you did your adjustments correctly. Okay? And secondly, did we transfer or did we sort the accounts out into the proper statements? Okay? And then what we do is we just add up those two numbers, which are going to equal this number. And we just do this last line to kind of show the reader that everything worked out. Okay? Hopefully that makes sense. Use this exhibit to help you. Okay? This is a sample that is there for you to help you whenever you have to do any worksheet. Okay? All right. That's all I have for you today. Hopefully you have a great day. We just have a couple problems for you to do. The sub should have the answer key if you want to check your work. as always, kind of use each other to help each other out. And then when I get back, maybe write down any questions you have. And then when I get back on Wednesday, we'll gladly help you out. Okay? Have a great day, and I'll see you soon. Bye.